Hello, everyone. I'm going to go ahead and get us started here. By way of introduction, my name is Madison Keka, and I wanted to begin by expressing my gratitude to everyone on this call for taking the time to listen to us today. This summer, I had the privilege of working alongside Jalissa Jonas, Connor Fitzpatrick, Lucas George, and Michael Wingerman while researching investing in AI. First, I began to center our readers by discussing the dot-com bubble burst of the 1990s, as some individuals fear similar results within the AI industry, in addition to remarks by Goldman Sachs' top stock analyst who expresses skepticism about the long-term impacts of AI. I then balanced this caution through examining the potential within the industry, along with remarks by a Toronto-based venture capital firm co-founder who believes that AI has the ability to replace every type of software over the next decade, valuing the industry at trillions of dollars. AI is an incredibly dynamic and transformative industry, and it is without a doubt that there are significant opportunities within this space in terms of investments that all investors are encouraged to explore. To navigate the investment landscape, we decided to tackle this industry from three different routes: individual stock selection, ETFs, and private markets. I'm now going to pass it over to Jalissa to discuss a little bit about AI innovations and infrastructure before we get into our three different investment routes.
Thank you, Madison. Artificial intelligence, which was once a figment of societal imagination, has really emerged as a transformative force in our world. AI is not just reshaping industries, but it's also transforming daily life. And to better understand AI's impact, we created a unique definition that categorizes the beneficiaries of AI into two groups. Primary beneficiaries are responsible for the direct growth of AI. We think to companies like NVIDIA and IBM, which are developing AI algorithms, data processing systems, and machine learning models, laying the groundwork for these secondary beneficiaries, who are the companies that leverage AI in their various industries to enhance and better their outcomes. There are not many industries that have really gone untouched from the benefits of AI. If we look to healthcare, AI is driving significant advancements. It accelerates research, diagnostics, and treatment, and it directly helps to improve patient outcomes. Because of the ability of AI to focus on large amounts of information, AI is helping doctors to focus on what really matters, their patients. Within the automotive industry, we have seen companies like Tesla and Waymo integrate AI to develop automated transport solutions. These innovations not only improve the safety and efficiency of drivers, but they help to reduce traffic incidents and emissions, and they also create lucrative investment opportunities. In retail, AI has been revolutionizing the consumer experience. Now we have more satisfied and therefore more loyal customers. Chatbots have been aiding customer service representatives, significantly cutting costs and improving efficiency. Beyond these industries, AI profoundly impacts our personal lives, helping us to do our best in all that we do with more efficiency. So with all this innovation, the question for investors is now, how do we approach these investments? Are we supposed to identify specific winners, or are we going to adopt a broader strategy for industry exposure? This is a key area that Lucas will provide more insight on next.
Thanks, Jalissa. So within the individual stock space, it's very much high risk, high reward. Especially within a space like AI, there are absolutely going to be winners and there are going to be losers. And I like to mention a quote by Harry Markowitz, who's kind of the father of portfolio theory. It says diversification is the only free lunch, as it allows for increased returns at a given level of risk. And we feel for most investors, this diversified strategy is where you want to be. However, for those who are still interested in just individual stock picking, multiple and ratios are not enough to choose companies. You need to run a model. And so a majority of my research was spent on creating a discounted cash flow analysis model, which values a company based on the present value of its cash flows and the present value of its terminal value. And so in order to do this, you have to project out a company's financials using assumptions for their revenue growth, their changes in expenses, as well as their working capital. After that, you get down to their free cash flow for each year, and you're going to add together all of the free cash flows. Generally, for our model, we did 5 years. It's generally about 5 to 7 years that you're going to model out the individual year. And then you're going to add those together and discount those back to the present value using a weighted average cost of capital, which you can think about as the risk of the company, the risk level of the company. And then once you have that value, you're going to determine your terminal value. We use the Gordon growth method for ours. And then this is the value of the company at the end of the 5 years for our specific model. So essentially the value of that company until the company ends. This is difficult to do, not just because DCFs are relatively complex, but because the assumptions that you're putting in have to be correct. Especially if you're putting all of your eggs in one basket, so to speak, you have to be spot on with your assumptions and your model. And so we did our model on NVIDIA, and we used data before last week where their price was around $115 per share. And in running this model, we worked backwards to figure out that the markets had factored in annual revenue growth of 31% over the next 5 years and a cash flow margin of 46%. And a key takeaway that we found from this research is that these models are very sensitive to changes in your assumptions. If we factored in a 50% revenue growth and a 55% cash flow margin, which you can see in that green box on the sensitivity analysis, the stock should be trading at $230 per share. However, if we don't think NVIDIA is going to be doing well and we think that they'll maintain a 20% annual growth rate with a 35% cash flow margin, which I might add is still significant growth, annual growth, the stock should only be trading at $63. And so in conclusion, we feel that picking stocks requires significant skill, time, and frankly, luck, because there are factors in the world that affect the economy that you just cannot predict. And so we feel that a more diversified investment strategy is better for most investors, like an ETF, which is where I'll hand it over to Connor.
Yeah, thanks, Lucas. As you mentioned, ETFs are a great way to diversify your portfolio while also seeking high returns. Although ETFs are easier to select than individual stocks, I believe, especially in the AI space, you should really understand the ETF before you invest in it. In my paper, I found it was super clear to divide AI ETFs into 3 main sections: broad AI ETFs, semiconductor ETFs, and digital infrastructure REITs ETFs. First, I looked at Invesco's IGBT ETF. This is what I would call a broad AI ETF, with its selection criteria being companies that derive at least 50% of their revenue from subsectors related to future software development. For this ETF, I would think, big AI players such as NVIDIA, Meta, Google, and AMD. Next, I look into iShares Semiconductor ETF, SOX. This ETF contains the 30 largest semiconductor producers in the US. Again, think NVIDIA, AMD, and Broadcom. These are really the 3 biggest producers of the semiconductors right now, which are a crucial component of the hardware that powers AI tech. Then I looked into iShares US Digital Infrastructure and Real Estate ETF. This ETF targets companies involved in the infrastructure to support digital data essential for the growth of AI. As you can see on the graph on the right, in 2024, market cap weighted ETFs have significantly outperformed the equal weighted ETFs because of these large companies such as NVIDIA with such high market caps. They've really driven returns. So if you believe in the strength of these large companies and desire diversification, market cap weighted ETFs are a great option. If you anticipate an increase in competition or regulatory actions against large firms, equal weighted ETFs would be better suited for you. Personally, as we've seen in the past with tech stocks, I think the big companies will continue to get even bigger, which is why I would suggest market cap weighted ETFs. And now I'll be passing it on to Mike for more on private markets.
Thank you, Connor. So for my part of the research, I focused on the private market investing, which is a big major part of AI right now, as many investors are rushing to get in on the bottom floor. Private markets offer a way to increase exposure to AI because you're able to devote much more capital into much more specialized products and projects. Part of my research was figuring out the landscape of AI, and so a big movement we're seeing now is many more companies are staying private or moving private. And so on the right, you can see it's kind of stabilizing now, but since the mid 1990s, we've seen a halving of the number of public companies. And this means two things. One, there's a lot less opportunities for investors in the public markets, and this can lead to higher valuations of those companies. And then two, there's a lot more opportunities for people in the private markets, especially these companies that are researching venture capital projects and private equity firms that are trying to buy new companies. They're able to, invest in new portfolio companies that have much lower valuations. Like I said, there's two major types of investments that we're seeing in the AI space right now: venture capital and private equity. Venture capital investments you might have heard of would be like XAI, OpenAI's ChatGPT, and Anthropic. These are startup companies that are not established, but they have a lot of room for growth and a lot of potential. And so you put capital into those companies and hope that you see large profits. And then private equity would be companies that are going into previously established companies and then buying ownership and helping to make those companies more efficient, more productive, and that would increase profits for those companies. For our recommendation, we believe that investing in private markets takes much more capital and much more knowledge than these other investments that we previously spoke about. And so most people would not have access to this. So it might not be feasible for most people, but because it offers such a high return, and if you are willing to put in much more capital and you have the knowledge, it does serve as a really, really important category. And also it's going to continue to grow over the next couple of years. So it's definitely worth looking into. I'll pass it over to Madison to conclude.
Okay, so to wrap things up here, we found that choosing to invest in AI through individual stock selection can offer significant upside. However, it carries a great deal of risk if investors allocate to those more poor performing stocks. As a team, we truly embrace the principles of diversification and believe ETFs provide a superior vehicle to gain exposure. When taking that ETF route, it's incredibly important that investors remain mindful of two things: weighting methodology and also the targeted exposure. It is challenging for individuals to enter private markets. However, there are a lot of growing opportunities in this space for institutional investors and high net worth individuals. Investing in AI through private equity presents high potential returns and that diversification that we're looking for, yet this form of investing is typically associated with both illiquidity and risk. Overall, it is an immensely exciting time to be an investor in such an innovative industry with incredible opportunities and potential. It's important that investors carefully weigh all factors in accordance with their own goals, risk tolerance, and time horizon when determining their personal approach to investing in this space. Lastly, I just wanted to take a few moments to thank our two wonderful mentors, Rick Thomas and Chris Bendel, as well as our alumni mentor, Molly Furr, as they were all instrumental to our success this summer. As a team, we would like to further thank Mr. Craven and all the higher-ups at Sapere Aude, all team mentors, and all of the professionals that took the time out of their incredibly busy lives for investing in us. Thank you, and we would now like to open up the floor to any and all questions.
Go ahead, Rob.
Thank you. Great presentation, really interesting, tough topic, and I love the way you approached it, so congrats on that. Wanted to ask a question about your comment in regard to the number of companies in the public markets and then your subsequent remark around valuations in the private markets. And was the comment that the decrease in the number of publicly traded securities available drives higher valuations a broad comment, or was that specifically to AI related companies? That's the first part of the question.
Okay. I think in general, I mean, I think if there's less opportunities, I think there's a lot of public investors and there's a lot they don't have access to these private companies, and more companies are moving private. I think that could lead to higher valuations in these public companies as they're forced to pick between less opportunities. If there's less companies that they can pick between, and everyone seems to go for the same public companies, then that could lead to higher valuations for those companies. And then
Okay,
also
so
in the private
yes.
markets, because less people have access to them, there's more opportunities to find, cheaper valuations.
Okay, so there was no empirical evidence that supported, like I was going to ask for the study that showed less companies related to higher valuations. I understand the context now. So then explain a little bit more why the valuations, how you conclude the valuations in the private markets are lower.
Well, because my reasoning behind that was, as I was reading on it on different websites, and the website that was I sourced in my site was talking about it. But if people have, there's less access to those companies, and these are new and up and coming companies, they might not have as much research on them because they're private, and that means these companies are able to look at them and really heavily research them. Companies that wouldn't previously have been more heavily researched, and find these opportunities, find these cheaper valuations, that because these public companies have so much information out already that these private companies don't. There's an advantage for these private markets, and that's why a lot of investors are going to the private markets. They're able to get those higher returns because of that.
Okay, well, there's a lot to unpack on that, so maybe we could have a conversation another time. But I'm not sure I completely agree with that conclusion, but I understand the rationale. Anyways, really interesting and good stuff, and thank you for sharing your thoughts. I appreciate it.
Go ahead, Joe.
When Rick raised this as a potential topic in the spring, I immediately thought, wow, this would be really awesome, given a lot of the issues he raised about versus individual stocks versus market or equal weighted ETFs and private markets. I think it really came together well. If you zoom out and look at the whole board, the way you presented it, it really challenges you in terms of thinking about this. I think, one of the points Rob was making is, OpenAI or ChatGPT's estimated market value as a company is probably pretty close to $100 billion now. So it's not your normal venture capital investment, which I think makes this space very unique. Anthropic, same thing. And getting access to those companies in the private markets is exceedingly difficult, especially for the investors on this call. So I think the context that you put this in is really good. Lucas, I think Lucas, the way you presented the individual stock analysis on NVIDIA and sort of saying it doesn't take a lot of impact on growth to really move that stock price a lot. So, I think staying focused on that and being able to communicate that when you're talking in your networking calls and interviewing around what you looked at, I think was really, really good. And I also think the other thing that I would dive into is the difference between the market cap weighted ETFs versus the equal cap weighted ETFs. We've talked about this in AUA before, which is if you buy IVV, if you buy the S&P 500, you're getting a pretty significant weight in AI because you own NVIDIA, you own Meta, you own Google, you own Amazon, you own a lot of the big companies that are really investing in this space. You probably are owning, 15 or 20% of the S&P is in this space. So this notion of investing in equal weighted ETFs is something I think we should be looking at. I'm going to look at a little bit more carefully from my own self, which is, how do you get exposure to some companies that aren't necessarily in the main indices? So I really think you did a really good job, and we're grateful for your hard work.
Thank you, Joe.
Joe?
Go ahead,
Joe.
Joe Janaka.
Thank you. Great presentation, great topic. I commend all of you. It was very thought-provoking. Madison, I think you said at the outset you talked about a bubble. I think you sort of related it to the .com bubble, and I'm just curious how much of that made its way into kind of your research and ultimately the paper. Joe's observation just now about sort of the construct of the S&P and every company he named are part of that concentration problem of the S&P, right? With the Magnificent Seven has been driving the performance of the S&P 500. And I read something the other day, interesting. 40% of NVIDIA's revenues come from the Magnificent Seven. So I'm curious, that bubble notion, Madison, or anybody else, how does sort of that make its way into this? Because NVIDIA's dip, right, was when you were talking about the model, NVIDIA's dip last week was I believe an issue with supply chain. So talk to me about the bubble notion, about where that ended up in your thinking relative to this topic.
Yeah, of course. So when I first started my research and sort of like trying to figure out how we were going to frame this research in a way and connect it to sort of past financial trends, I noticed there was a ton of articles across the board, JP Morgan, Bloomberg, just a lot of different really reputable sources sort of comparing what we see with AI a little bit to sort of that bubble burst in the 90s with the tech stocks. However, I more or less use it as a framing measure to sort of bring in this idea of caution. I also talked a little bit about, we have Goldman Sachs, their top stock analyst, Jim Covello. I believe it was 2 weeks ago with the Bloomberg article, sort of talking about how he doesn't see AI to be all that, as more of a cautionary tale. However, I think there's a lot more reputable sources and a lot more research. And, you even see it with the numbers, just how much potential there is in the industry and how it's changing almost every single day. So I don't think that AI is a bubble. I think it was more of just sort of a framing measure, at least in my opinion.
And I can add to that. As we were looking as to the idea of a bubble, a lot of people have been waiting for kind of AI to burst. Many people are thinking like, oh, it's just something that's a fanatic right now. And so many people have their attention on this because it's the newest thing. And so even when I was looking at innovation surrounding AI, I think what a lot of the conversations I was having, even surrounding networking as I was doing this topic, many people were expressing to me, people who are in the field were expressing that, yes, AI is something that I'm using in my day-to-day, but I don't think that this is something that's necessarily revolutionary. So I've gotten the opinions on both sides of the board, where there are some people who think like this is the next best thing, and then there's other people who think that there's just too much focus and too much attention on this right now. But as I went into the research and I saw the innovations, it surprised me how much AI is integrated into the daily life of each person, regardless of whether we're aware of it or not. We're using AI. So because of that realization, I had thought to myself, like, there's simply no way that this could be a bubble, considering how important AI is becoming in our day-to-day life.
One comment to that, Jalissa, I agree with you, is to think about we get focused in these moments on AI and those companies associated with AI. And so you have short-term hype. But what the reality is, in the long term, AI is going to have profound implications on all of us in every industry. So the industrials, energy, in particular, energy, utilities related to those consumer staples. So it's a matter of seeing the hype now and versus what's going to happen in the long run. Warren Buffett always said that stock market in the short term is a voting machine, in the long term it's a weighing machine, and I think that's going to lend itself true to AI as well. 5 stocks year to date before the broadening that started a couple weeks ago had contributed $4 trillion to global market cap, and half of that was NVIDIA. So is that a bubble? I don't know, but it certainly is hyped. The difference today, we think a lot about this environment relating back to the Nifty 50 versus of the 50s versus 50s and 60s versus the dot-com, is these companies are amazing companies, profitable beyond imagination. Google, Amazon, NVIDIA. So it's very different than the hype of the dot-com, but it doesn't mean that they are overhyped. And your model and the insight you guys gleaned and shared with all of us is that your assumptions matter, and that growth rate, well, you can come up with very different valuations. And so the skeptic in me, Mike, is, or Michael, is it in the private markets, I have the power to negotiate the valuation. So it may look like a value, but they could be assuming growth rates that just aren't tenable. So therefore, people can be overpaying and not understanding it because it's a private market. But anyway, sorry, this is just such a fascinating comment. I couldn't resist. So thank you all for your insights and perspective. Well done.
Thank you, Rob. Go ahead, Melissa.
Yeah, quick comment first. I thought you all did a great job of, approaching a topic that is, just in the news every day. We're hearing about AI. So thanks for, bringing that, down into bite-sized chunks for us in this presentation. And, looking at, I always wonder like what surprises you had. So of course, because this has been in the news, you approached this with some, this presentation and your overall research with some preconceived notions. And I was wondering if, along the way, as you've dug down into the facts behind those, if there were any surprises for any of you on the subject.
Yeah, I can take this one. I was a little bit of an NVIDIA skeptic going into this until I kind of researched their financials and I realized that they've been averaging 50% revenue growth for the past 3 years. And like once I was able to look into their DCF and see that their valuation is pretty justified, that was a surprise to me.
I could take this as well. When I was originally researching it, I had really no idea that so many like big companies like Amazon, Microsoft, they're all making these huge venture capital investments or like buying out companies in the AI space. And I hadn't even read about it. They're spending billions to invest in these new companies that are up and coming. And I usually thought it would just be these venture capital companies that were taking these risks on these companies. But yeah, a lot of major corporations are investing in the AI space, like Microsoft, Amazon, to help their own companies grow.
Scott Galloway had a podcast last week where he explored the CapEx expenditures of U.S. companies in AI. And those top 5 companies are spending more than the United States government is on Homeland Security on their CapEx in the last year on AI. So it's just a stunning. So Rob's assessment of it is absolutely correct, which is this is transformational, and we don't really know yet how it's going to play out. But I love the way you express it, Madison. This is not an AI bubble, but there might be bubbles inside of this that represent different companies and how they're being valued. So I do think this is a great topic. I'm really grateful for Rick for raising it. And I'm looking forward to hearing back from you on how the conversations you have with various people that you're talking to around it. So really, really good job. Thank you.
Joe, that CapEx is probably everybody buying NVIDIA's H100, H200 chips. Because what was interesting when we looked at NVIDIA's financials is their CapEx is actually very low. So that surprised me that NVIDIA has very low CapEx. Everybody else has really high CapEx because they're buying NVIDIA's products. So they're in the sweet spot.
and they were smart enough not to actually manufacture the chips. So,
Yes.
but really good job. And I would think that you will continue to work on this and continue to evolve your thoughts and become an expert in this space, which I think is really, which is part of the reason we do this, right? Is that you can continue to work on this. So really, really good job.